We are going to solve another question today. The question is on construction account. It's also a past exam question that students can solve. So I'm going to read out the question and then solve it. Omega PLC and Sigma PLC agreed to amalgamate their businesses by forming a new company known as Unity Industries PLC on 1st January 2025. Summarized statements of financial position immediately before construction were as follows. Omega PLC. I'm going to give the one for Omega PLC and then the one for Sigma PLC. I might also join it later for space. Equity and liabilities in thousands. Ordinary share capital of ₦1 each, 70 million. Share premium, 10 million. Retained earnings, 18 million. 12% loan notes, 35 million. Trade payables, 47 million. Total, 180. Total of equity and liabilities. Assets in thousands too. Land and buildings, 80 million. Plant and equipment, 45 million. Inventory, 28 million. Trade receivables, 20 million. Bank, 7 million. Total assets, 180 million. That's for Omega PLC. For Sigma PLC, we have equity and liabilities in thousand. Ordinary share capital of ₦1 each, 55 million. General reserve, 8 million. Retained earnings, 12 million. 10% loan notes, 25 million. And trade payables, 40 million. Total equity and liabilities, 140 million. Assets in thousands. Land and building, 60 million. Plant and equipment, 35 million. Inventory, 25 million. Trade receivables, 16 million. Cash, 40 million. Total, 140 million. Scheme of reconstruction. Unity Industries PLC was incorporated with an authorized share capital of 300 million. Ordinary shares of ₦1 each. The company acquired the business of Omega PLC and Sigma PLC on the following terms. Omega PLC. The business is acquired in exchange for cash, 30 million naira. Ordinary shares in Unity Industries PLC valued at 2.5, 2 naira 50 kobo each, 50 million naira. Loan notes redeemable after 5 years, 40 million naira. Sigma PLC, the business is acquired in exchange for cash, 20 million naira. Ordinary shares in Unity Industry PLC valued at 2.2 naira 50 kobo each, 35 million naira. Loan notes, 40 million naira. The appropriate market discount rate for similar debt instruments is 12% per annum. Accordingly, the deferred consideration is to be recognized initially at its present value. Unity Industries PLC also issued 40 million ordinary shares of ₦1 each at 2 naira 50 kobo per share to the public. The issue was fully subscribed and all monies were received. The acquisition costs amounted to 3 million naira paid by bank. The following fair value adjustments were agreed. Omega PLC, item adjustment, lands and buildings increased by 8 million. Plant decreased by 3 million. Inventory increased by 2 million. Trade receivables decreased by 1 million. Sigma PLC, item adjustment, land and buildings increased by 5 million. Plant increased by 2 million. Inventory decreased by 1 million. Trade receivable decreased by 5 million. Assume that all assets and liabilities and the existing loan notes were taken over by Unity Industries PLC. Required, calculate the present value of the deferred purchase consideration, that is loan notes, issued to Omega PLC, Sigma PLC using the market discount rate of 12%. Present value factors for 1 naira receivable after 5 years at 12%. 2. Calculate the purchase considerations and amount of goodwill or bargain purchase gain arising on acquisition of Omega PLC and Sigma PLC. C. Close the books of Omega PLC and Sigma PLC. E. Open the books of Unity Industries PLC. And F. Prepare the opening statement of financial position of Unity Industries PLC immediately after the reconstruction. Now, this is a full reconstruction question that is testing IFRS 310, and then it's also testing 9. We are looking at financial instruments. We're also looking at combination and consolidation. I combine this in order to test the knowledge in all these areas. So I'm going to do the solution now. We'll start by losing the books of the old company. That's where we're going to start. The book of the old companies will be closed at the book value of the assets, liabilities, and equity. We are going to form a realization account. Since everything was taken over, we are going to realize all. So realization account for Omega PLC. Omega PLC's realization account. We have land and buildings in thousands, 80 million. Plant and equipment, 45 million. These are debited. Inventory, 28 million. Trade receivables, 20 million. Bank, 7 million. Now, we are not going to consider the realization cost here because it was not borne by the old companies, but by the new company. So that's where we are going to look at it. And it's not also part of the consideration. So when we're looking now in the book of the new company, we're going to consider the realization costs. Now, they took over the loan notes. They took over the loan notes of 12%. So we're going to credit the realization account with it, 35 million. And then also the trade receivables, 47 million. Then the consideration paid is 102. I'm going to show you how the consideration became 102. We'll look at the consideration so that you will now know how the consideration became this amount. They paid cash, 30 million, and ordinary shares of 50 million. Then the loan note is a zero coupon. There is no rate in it. It's only going to be redeemable in the fifth year for 40 million. So what it means is that the amount that is invested is a discounted amount. So that 40 million for 5 years, this is the way we computed it. 40 over 1 plus 0.12, which is the rate. raised to power 5. So since the two companies has 40-40, the resultant effect is 22,697,000 approximated for the two. That's it here. So we are using amount equal to 1 divided by 1 over divided by 1 plus r raised to power 5. This is a normal calculation that I have already shown you before today. And if you don't know it, go and check present value calculation. You'll be able to understand it. So that's how the consideration becomes 102,697 and here 77,697. So we go back to the closing of the old books since I've explained this. Okay, so the Unity Industry PLC agreed to pay a consideration of 102,697. This should be 697. So profit transferred to sundry shareholders account. That is the difference between credit and debit. There is a credit balance, so it's going to be a profit. If it's a debit balance, it would have been goodwill. For Omega, in Omega's book, yeah, we are still treating Omega's book. We are closing Omega's book. We are going to create the purchasing company's account, which is Unity Industry PLC. We are going to open that account in Omega's book. Now, at the agreement of purchase consideration, we are going to debit the company that is buying, or the new company that was formed. We are going to debit the account of that company in the book of the old company to show that there is agreement to pay that amount, and credit the realization account in the book of the old company. This has not been paid, it's only agreement. So that's why we came here and debited it. Now, we have the bank account that we opened. Bank account, the balance brought down was 7,000 and it's realized in the realization account 7,000. Then we have the sundry shareholders account, which we closed. We brought down ordinary shares of 70 million, brought down share premium of 10 million, and retained earnings of 8 million. Then we also brought down the profit on realization account of 4,696,000. Okay, sorry, this should be 7 now because I corrected it. This should also be 7. Yeah. So now remember that the books, the account of the new company has also to be closed when they make their payment or when they transfer their consideration. The first consideration was cash, 10,000, which goes to the sundry shareholders account. And then the second consideration was 50,000, while the zero coupon rate was 22,797. So this balanced the account, and the book of the old company has been entirely closed. The book of the old company has been entirely closed. So it shows that this is what they used to acquire this. Then we are going to also close the book of Sigma. The book that we close now is the book of Omega. We are going to close the book of Sigma. We are going to also use the same method. So we have a realization account where all the assets are realized, land and building at the book value, plant and machinery, inventory, trade receivables, and then bank, because bank was taken over. Then we come here on the credit side, 10% loan notes. 10% loan notes, 25,000. Trade payables, 40,000. And Unity Industry PLC purchase consideration, 70,000. Like 77,697 naira. Here, we also turn to 7. So that's the realization account. And then we open Unity Industries account in Omega's book. And we debit it with the realization account of 77,697. Okay, that's million now. 77,697,000. Okay, when the money was paid, when the consideration was transferred, we credit that account to show that they have fulfilled their obligation. Bank, 20,000. Ordinary shares, 35,000. Loan notes, 22,000. 22 million. All these ones are million. Please take it like that. They are million. They are in millions. So 22.7 million. Now, the bank also will close the bank account. Then, sundry shareholders account. We bring all the consideration down here. And then we also close the equity account or shareholders account, ordinary shares, general reserve, retained earnings, and then bring down the profit on realization of 2697. This one is 22697. Sorry, I adjusted that, but I didn't adjust it here, so that's why I'm trying to adjust it now. Okay, so this one has also been closed. We're now going to open the books of the new company. Okay, we are going to open the book of the new company, Unity Industry PLC. First, we'll calculate the goodwill. So I've already shown you how we calculated the purchase consideration by discounting that 40 million loan notes. Then the goodwill, we calculate the goodwill and gain of on bargain purchase. We have the fair value of assets acquired for Omega and Sigma. Sorry, this should be Sigma. These are, we considered the adjustment in the value of the asset. Remember, the question shows increase and decreases in different assets. So land and buildings, this is the fair value for Omega, this is the fair value for Sigma. Plant and equipment, fair value for Omega, fair value for Sigma. Inventory, these are the fair values for the two companies. Trade receivables, and then banks that were taken over. Then we less the liabilities, loan notes. Okay, the 35% and 35 million and 25 million. Trade receivables, this 47 and 40. Total liabilities, this, and then net asset, which is this minus this. We have 100 million here, and we have 850 million. So the total is 2697. The goodwill here yielded a bargain purchase gain 2,803,000 because it's a negative goodwill. Okay, so we have calculated the goodwill and the bargain purchase, gain on bargain purchase. So let's look at the account of the new company. We have to open the business purchase account. Of course, in the business purchase account, we are going to take over all the assets and the liabilities. All the assets and the liabilities will be taken over. Okay, so land, if you add the two lands, that's land and building, 53 million. That's where I am getting it. I'm adding them up, adding everything here up, everything here. So we come here. Land and building for Omega and for Sigma, 53 million. Plant and equipment for the two, 79 million. Inventory, 50 million. Trade receivables, 34.5 million. Bank, that's 7,000 plus 4,000, 11 million. Then we have the purchase consideration that was given to Omega, 102. We have the one for Sigma, 77,697. And then the loan notes that was taken over, 12% loan note, 35 million. 10% loan notes, 25 million. And then the addition of the trade receivable, 47 and 47 and 40, we have 87 million. Now, remember that in acquiring the companies, we have two things. The goodwill that came as a result of acquiring Omega and the bargain purchase that arose as a result of acquiring Sigma. That will be a profit because the standard says it should be recognized immediately in the income statement. So we are recognizing, we did not net it off like this minus this. We will not do that because the treatments are different. You will treat goodwill, this one as goodwill, and show it in the same financial position, while you treat this one as profit or loss. So that's why we did net it off. So if you net it off, you have failed it because that means we did not follow the standard. So this is the way we have treated it. You can see it there. Then Omega PLC vendor account. We're also going to open the vendor account. Remember that in closing the books of account, we recognize Unity Industries as debtor of Omega PLC. So in this place too, we are going to recognize Omega PLC as a creditor of Unity Industries. So that's why we are crediting this account, Omega PLC account, with that purchase consideration. This is the agreement. So at the point of agreement, we raised debts and credit and liabilities. What it means is that Omega is Unity Industries is recognizing Omega as a company that are owing at the agreement. And then in the Omega's books, we also recognize Unity Industries at time that they are owing Omega. So they were debtors in their account, and now these are creditors in the other people's account. Now at payment, they paid cash. They also issued loan notes and issued ordinary shares. So these are also recognized to close the account. The same thing goes to Sigma. The business purchase account, we have this amount. Look at it here. So we credited this. Then on payments, when Sigma received payment, we debited it with all the consideration, which also closed the account. Then we opened the ordinary share account. Omega PLC vendor acquired 20 million. Sigma acquired 14 million. Then there is a public issue of 40 million. So that is a total of 74 million, which is this. And then there was ordinary share premium of Omega PLC, 30 million, Sigma, 21 million, and public issue, 60 million. I will show you how this was done. Remember, let's look at the acquisition of shares. They say the business is acquired in exchange for, let me show you that let me bring the question so that you understand how the shares were acquired. The business is acquired in exchange for ordinary shares in Unity Industry PLC, valued at 2.5, 2 naira 50 kobo each. And the ordinary share value is 1 naira, the nominal value. So if they acquired this, the ordinary shares that was acquired by Omega in Unity, they paid for 1 shares, they paid 2 naira 50 kobo each. So we do 50 divided by 2.5. So which means what they acquired was 20 million shares. The remaining value of the 50 million was paid as premium, not as shares. So take note of this. The share value, the share nominal value is 1 naira, but they paid 2 naira 50 kobo. What it means that 1 naira 50 kobo is premium. So what we need to calculate the value of shares that was acquired is to divide 50 million by the price of the share to get 20 million. Now the remaining 30 million we treated as premium. The same goes to Sigma. Sigma is 35 million divided by 2.5. That's 14 million. The remaining one will now be premium. That will be 35 minus 14. Then the new public issue was 40 million. That was what was issued, 40 million at 2.5. So the difference, that is the total amount realized, is 100 million. The difference is 60 million. This will also be considered as a premium. So that's how we got the premium account. They issued 40 million ordinary shares of 1 naira each at 2.5, 2 naira 50 kobo. So what it means that they realized 100 million in the issue of these shares, but only 40 million is the nominal value of shares. That's what we are going to recognize. So I think I have cleared both the share account and the premium account. So we can go on in the solution. Okay, so that's why the ordinary share account has, ordinary share premium account has a balance brought down of 111 million. Then the zero rate coupon loan notes. Of course, these are the amount that we calculated before. I've shown how it was calculated. And the balance brought down is 45 million. Then the 12% loan notes, of course, we brought it down to, balance brought down is 35 million. And the 10% loan notes, balance brought down is 25 million. So this is, we have opened the book of the new company. So the next one now is to prepare the statement of financial position of the new company, the opening statement of financial position. Okay, Unity Industry PLC, opening statement of financial position immediately after the acquisition. So we have assets, start with non-current asset, goodwill. Of course, we have calculated it there. Land and buildings, we took it from the business purchase account. Plants and equipment, we took it also from the business purchase account. Total non-current assets, 234,697. Current assets, inventory, 50,000. Trade receivable, 34,000. Bank. Then we need to add that realization. Let me tell you what the acquisition cost amounted to this. So the acquisition cost of 3 million, we need to consider it. So we removed it from the bank balance because they said it was paid through bank. So we are going to remove it from the bank balance to have 58,000. Then we have total current assets of 142,500. Then total assets of this plus this gives us 377,197. Okay. Okay, let's go to equity and liabilities. We'll start with equity. Remember that the company has authorized share capital of 300 million. We have to present it. That is a presentation matter. So even though we're not going to add it to the total equity, but we have to present it as authorized share capital of 1 naira each, 300 million. Then we have the issued and fully paid ordinary share capital, which we derived from this account, 74 million. And then the premium is also derived from this account, the share premium account, 111000. And then we have the retained earnings. The retained earnings will be that bargain purchase and the acquisition related costs. So we minus the acquisition related costs from the retained earnings. We have explained earlier that acquisition related costs will be written off. The zero coupon loan notes, 45,394 naira. Then the 12% loan note, this is in the account, 35,000. The 10% loan note, 25,000. Total current liabilities, 405,394. Of course, this is a million, please don't mind my thousands. Current liabilities, trade payables, addition of the two, 87,000. One was 40,000, one is 47. So you add it up, 87,000. So we have our balance statement of financial position. Total equity and liabilities, 377,197. The difference is zero, so we balanced it. Okay, so the next one now is to show the treatment of the zero rate, the zero coupon that was issued in acquisition of the companies. Okay, so we have year opening carrying amount and finance costs at 12%, then closing carrying amount. So the first year, the zero coupon loan note was 45,397,000. 12% of it will be 5447.64. And then when you add up, you see the closing carrying amount of this amount, 5844.64. Then that is what you are going to use here for the second year, and you apply the 12%, you add it up, you have this. Third year, you take the closing amount, apply 12%, and the Fourth year, the same thing, apply 12%. The fifth year, let me remove this. The fifth year becomes 71 million, apply 12%. This was adjusted, reduced by, I think, 7.03, not the actual value here, so that the amount that will be paid will be 80 million. So in the provisions, you make that adjustment so that it will not be more than 80 million. Even when you take loan from bank, that adjustment is always made at the end of the period. Okay, so now, how do you account for it in the book after the computation? Initial recognition, that is date of acquisition. You recognize 45,394,000. Remember that is a summation of the two, the one they pay to Omega and the one they pay to Sigma. So this is how it is. Then in the second year, the first year, you debit vendor accounts with this, which we saw. In the second year, the same year, you credit the loan note account with this amount. In the second year, you debit finance costs and then the loan notes. That these figures have already been calculated. So that's what you do until the fifth year. So at the end of the fifth year, the balance of the loan notes will become 80,000. So that is when you will pay it. So you debit the loan account and then credit the bank account with 50,000. The liability is now fully extinguished. You have paid everybody. So this is the requirement of the question. We have given the solution based on what the question required. I believe that if you spend some time in practicing this, you'll be able to understand it very well. And then if you have such question in exam, it will not be difficult for you. Whatever exam you are writing, this is how you are going to solve the question. This is what we provide to every one of you, both those who are in my class and those who are watching for other exams. So please go ahead and continue to watch my videos, follow, subscribe, and share to your loved ones that you know need this, so that it will help them. I want to thank you for watching. Bye.